Thank you, and thank you for the invitation to the organizers. I'm going to present a flash version, a very distilled version of my working paper, Mind the Gap, Disagreement, and Credible Monetary Policy. So let me start with actually some flash motivation. I would say that it's arguably one of the key themes today's in monetary policy discussion is the ability of central banks to influence markets' beliefs. And of course, their failures to do so. What I will argue is that one of the manifestations of such failures is interest rate disagreement. And my job here will be to convince you that this is a first-order policy concern. So let me give you a glimpse into what disagreement looks like. Here I'm showing market forecasts as extracted from financial futures compared to the Fed economist expectation is extracted verbatim from the Till books. And both are compared with the realization of the interest rate. What I'd like you to take away from this illustration is that monetary policy disagreement, interest rate disagreement, is a key feature of US monetary policy. It is a persistent and pervasive feature, and at times it reaches even highs of 250 basis points, which is a remarkable magnitude for these highly attentive agents like financial markets and Fed economists. So given the short amount of time, let me give you some key takeaways to the question, which is how does Fed market interest rate disagreement affect monetary policy transmission? Well, first, I'm going to show that disagreement does matter. It attenuates and sometimes can even reverse the response of activity to monetary policy. I won't have time to cover the second finding, which is about that information channels cannot be the whole stories. These are very popular channels that I show cannot fully explain this attenuation evidence. And finally, I'm going to show that in a generalized new Keynesian framework, we can understand the key mechanism that is driving such attenuation by just keeping track of this new state variable, which I call disagreement. And finally, to the deeper question of where is this disagreement coming from, I model this with a state space model of market learning, which decomposes the disagreement drivers into its possible sources, which I'm gonna dive in a second. In the interest of time, I'm going to go very fast here because I've already mentioned where the sources of Fed expectations and market expectations. I'm going to study, as I said, the transmission of monetary policy, which means that I need to perturb the system. I need shocks. And as a baseline, I will use high-frequency orthogonalized shocks from a separate paper of mine, which is available, but this is I'm going to use virtually any high-frequency shocks on the market, which comprise Bauer-Swanson, Gertel and Corradi, Arsiski and Corradi, Miranda, Grippino, you name it. So let me just show you the key result, at least empirically, which is which answers the question about if disagreement does matter for monetary policy transmission. How I address that is with lag-augmented local projections. This is the, I don't have time to go into the specific of the specification, but this is the Montiel-Olea and Plagemoor-Molder version. This, just to summarize, is the most conservative and state-of-the-art way to study the effect of monetary policy shocks in these scenarios. So let's agree on the two key objects of interest, which are alpha H and beta H. Alpha H measures the response to the shock when disagreement is zero, when the magnitude of disagreement is zero. So when Fed and markets agree on the future direction of interest rates. Beta H measures the marginal response, so the additional response of the outcome variable of interest. I'm going to show you in a minute, this will be activity, that is proportional to the entity of disagreement, to how much market and Fed disagree. So let me show you the key results, which are about activity, are about industrial production. On the left panel, I'm depicting alpha H, which is negative and statistically significant. How can we interpret this? Well, this is the standard macroeconomic textbook theory prediction. When interest rates go up, just quick summary, consumption is postponed, investment is shelved by investment, aggregate demand falls. What beta h on the right panel shows us is a positive and significant effect, which I interpret as evidence of attenuation. What the right panel is telling us is that in times of disagreement, there is a component of the outcome of the response of the outcome variable, which is proportional to the entity of disagreement. So we can interpret this as a state dependence. We can say that in times of high disagreement, the negative response, the conventional response, is attenuated more than in times of low disagreement. So I would like very much to discuss this more, but I want to convey how I think about this, how I rationalize this, and what lessons we can learn from this. So how I model this is through a generalized Neo-Kantian model in which market and Fed are allowed to disagree. Disagree about what? Interest rate. Where from? It's not relevant for the point that I'm going to make. Later on in the paper, I discuss every possible deviation from full information or rational expectation. But for the purpose of the point that I want to make, the disagreement augmented Euler equation that I want to introduce reads like this. Consumption in times of disagreement is equal to a term which represents consumption in times of agreement plus a wedge which is proportional to the entity of the disagreement, which is pretty intuitive in a linear model, right? Consumption under disagreement equal to consumption under agreement plus a wedge which is proportional to how much they disagree. Now, so disagreement enters the Euler equation as an intertemporal wedge, something that mutes intertemporal substitution, which is the key channel captured by Euler equations. Can we learn something from this? Is this useful? Well, if we solve for the equilibrium and we shock the system, we can find the analytical version of the state-dependent response that I've shown you in the empirical section. So this is what I do. This is how the output impulse response function reads for a generalized Neo-Kantian model as the one that I introduced. And I won't have that time to go into the details, but the impulse response function of y of output is equal to a term which is the baseline term, which is negative. This captures indeed the key Neo-Kantian model that I mentioned a moment ago, plus another term which is function, that is the term in pink, to psi-w, which is the impulse response function of the wedge of the entity of disagreement. So this is telling us, the model is teaching us that in order to understand how output changes, we also need to take into account, we also need to follow the dynamics of the wedge, the dynamics of disagreement. Now, this is a framework that is compatible both with attenuation and amplification. This is a general framework. So let's see if I can use some of the empirical moments that I've identified with the lag-augmented local projections in the empirical section to discipline the theory. So what were the empirical restrictions? I've argued that a beta h that is positive represents evidence of attenuation. How I've interpreted that, in times of high disagreement, the response of output is lower, it's higher in absolute value with respect to the response in times of low disagreement. What is the model teaching us? Well, the model is telling us that in order for this to be true, the wedge, the response of disagreement, needs to respond accordingly. Can we measure that? Yes, this is a testable implication because I introduced through my empirical proxy a way to measure how disagreement varies around the monetary policy decision. And in fact, very quickly, how the wedge responds is exactly consistent to how the model predicts, which means that the data is confirming the mechanism. We have state dependence wedge response. The response of disagreement reacts accordingly. Now, I have very little time, so let me address the last piece of the talk, which is what drives disagreement, what drives this wedge. I approach this in the most general possible way, putting in a wedge, in a state vector, all the possible sources that I could think of, which are market and Fed can disagree about fundamentals, inflation up to gap, can disagree about the reaction to fundamentals, and can disagree also on the credibility of signals that the Fed sends. So, for example, the forward guidance credibility. Now, this is a nonlinear problem, so I need to use an extended Kalman filter, which sounds fancy, but really is not that big of a deal, which means that the anatomy of disagreement, the disagreement that is generated by the model, will be a function of these three elements, which comes from the most possible general model. So disagreement about fundamentals, policy rule, and forward guidance. In the paper, obviously, I show how this conveys differently to the responses of the wedge, which in turn translate into the attenuation problem. Now, I'm 20 seconds the key mechanism being the higher disagreement implies slower learning, which implies attenuated transmission. I don't have time, so let me conclude with nothing, with this. Disagreement between Fed and markets does matter. It attenuates the transmission of monetary policy to output. And I haven't shown you point 2, so let me jump to point 3. Disagreement is tractable in your Ukensian model. It appears as a belief wedge that mutes intertemporal substitution, and a state-space model of learning decomposes disagreement drivers. And I apologize for these 56 seconds of delay.
So, time for questions.
Mr. University of Bonn. Nice presentation, thanks. I was wondering, the disagreement in the model and the disagreement in the impulse responses on the local projections, maybe I'm totally off. I mean, the local projections had like ST and then the absolute value of the disagreement. And in the New Keynesian model, that didn't seem to be the same interaction, was there? So how do the two things, align?
Should I answer or wait for more?
Martin has a question. Yeah, let's.
Yeah. So, is it on? Yeah. So, quick question on this. So, the paper seems to be. I think this is a very interesting idea, of course, and it's been documented in other cases too. This disagreement between what private sector markets think and what central banks think, and it reminds me a lot of conversations that were happening after 2008. And I think in particular, the Riksbank had issues back then, and they made actually all their data public in those days. You could actually see the disagreement between what the committee was talking about versus what markets were thinking. And back in those days, so I wrote a little paper with Ricardo Nunes and James Hepton. And so and this is a little bit of, maybe you can comment on this a little bit, we didn't take the idea about disagreement, but what we took was a story about differences in credibility or issues about the credibility of monetary policy, which fundamentally sort of is a very similar point, which of course played a lot of a role at the zero lower bound, but maybe outside, maybe that's more of the information story, but maybe you could comment on that a little bit. Thanks.
Oreste and Michael.
Just very quickly, could you comment on how important it is who disagrees? So your data was about the markets.
Yes.
In the model, when you think about the dynamic IS curve, we're thinking about consumers and firms, and we know that the expectations of those can differ quite a lot.
No, also a quick point, it was I was also struck by the absolute value that you had in up in one equation, because I would have thought that the natural interpretation is that if you think of a standard model, what matters is the private sector expectations of future real interest rates. And so if you now look at monetary policy, if the private sector thinks that rates are going to increase faster than what the central bank plans to do, then you're going to have a stronger reaction to monetary policy, and vice versa. So it seems like the definition of disagreement shouldn't be neutral to the sign of the difference.
Francesco, you got 1 minute.
Okay. Thank you for the questions. These are excellent inputs. Let me address first the absolute value questions, which are number 4 and number 1. It is true. I have in the model, in the empirics, the generalization where there are 2 beta H coefficient, one that multiplies the positive and one that multiplies the negative disagreement. The results are identical. They are symmetric. They're different in significance, but slightly so. The direction is the same. So I think that this specification is the most parsimonious one to bring home the point. And on this, I'm going to add on Oreste's question, disagreement in the model serves as the state over which the expectation of the market behave differently. So the expectation of the market, you're right, are the key driver of the model, of the mechanism of the model. In fact, the other equation that I've shown you starts as in the terms of expectation of the market. That is the driving force. However, how they react, how the expectation of the market react is different in cases of low disagreement and in cases of high disagreement. This is the sense in which the absolute value makes sense. I'm very late. 2008, the credibility question. Excellent question. This is why the theoretical part conveys both credibility and fundamentals and response to fundamentals. This is meant to encapsulate this very active discussion between information channel people and response to news people. This is a way to quantify, to put numbers on them. And this is the effectiveness of the gamma filter, extend the gamma filter. And finally, who actually is in the model? Who are the players that whose expectation of the market we study? You're correct. First of all, there is some evidence, recent evidence by Yuri Goroshinenko and other people that discuss how the expectation of households do vary a lot. I have an ongoing threat. But yet, you can generalize the same thing with investment equations. And everything goes through identically. Again, I apologize.
Nayeon, it's your turn. So our second presenter is Nayeon Kang from Deutsche Bundesbank. Oh, sorry. I guess,
should I go?
yeah, we need to flip presentations,
Okay.
I think. Oh,
Are
yeah.
we flipping presenters or presentations?
I think we have the second presentation by Nayeon Kang. So can we put it up? There we go.
Hi, my name is Nayeon Kang, and thank you for inviting me today. So, and the user disclaimer applies. I want to show my paper that, on how numerical inflation targeting shapes short-term inflation expectations. And in 2012, the Federal Reserve released their statement, their longer-run goals, their target, 2% inflation target to the public. And this single act of communication didn't just anchor long-term inflation expectation, it changes how individual forecasters fundamentally process information about short-term inflation. And inflation expectations are central to inflation dynamics. They feed into consumption decisions, pricing decisions, and investment decisions by firms. And in turn, they determine the realized inflation. So one direct method to managing inflation expectations is inflation targeting. Economists like Bernanke, Marvin Goffrein have emphasized the role of transparent communication and the importance of explicit targeting. So the Federal Reserve released a statement of longer-run goals and monetary policy strategy in 2012, and they articulated their 2% inflation target for the first time. And since then, much of the literature has focused on the anchoring effect of this communication on long-run inflation forecast. But the effect on short-term inflation expectations have been overlooked. Actually, short-run expectations are key in our daily life decision-making. So my research question is, how did the 2012 announcement affect short-run inflation expectations and through what mechanism? I documented 3 changes in short-term inflation expectations, specifically 1 year ahead inflation expectations. First, individual forecasters become more confident in their beliefs after 2012, which is measured by lower subjective uncertainty, again measured by second movement of individuals' predictive distribution. And second, individuals' point forecast expectations become less overreactive to news since 2012. And finally, disagreement across inflation forecasts falls since 2012. So to combine this, to understand these empirical findings together, we need a mechanism. I think that it is smooth diagnostic expectations. So once I establish my mechanism empirically, I embedded into new Keynesian models and show that how it contributes to stabilizing realized inflation in general equilibrium setting. So I analyzed the survey of professional forecasters' data at individual level to capture the changes in the first and the second moment of individuals' predictive distribution. And I feed a normal distribution to individuals' predictive density predictive distribution and computed standard deviation in interquartile range to capture the second moment. And selected median value to see how it evolves along the time. And as you see, in the first quarter of 2012, there is a structural break. Both measure sharply drops. So this is not driven by recession movement and more importantly, you can see the same pattern for economic growth uncertainty or unemployment rate uncertainty. So my first claim is that subjective uncertainty begins to decline in 2012. And to see what happened to the first moment, inflation expectations, I ran Koiven-Gordenichenko test. And I ran forecast errors on forecast revisions, and the intuition is very simple. Under rational expectations framework, the test coefficient should be close to 0. And if the test coefficient is negative sign, it means that individual forecasters are overreacting to their private information. Before 2012, test coefficient was statistically significantly negative signed, but after 2012, they become insignificant. So since 2012, individual forecasters for 4 quarters inflation expectations in a less distorted manner. So we see two facts that emerge simultaneously. So we need a framework that jointly explains these two findings. A natural mechanism is smooth diagnostic expectations framework, which is recently proposed by Bianchi, Elot, and Saijo. What distinguishes smooth diagnostic expectations framework from standard diagnostic expectations proposed by Bordalo et al. Is the role of uncertainty. So in the standard D model, new information influences only the conditional mean, the first moment, and they assume that the uncertainty remains at the true value of objective distribution. And the size of overreaction is governed by a single parameter theta. On the other hand, in the smooth diagnostic expectations framework, new information influences not only the first moment, but also the second moment. And the size of effective overreaction is scaled by R ratio, which is a ratio of current information uncertainty to past the reference information. In my model, I model inflation as a sum of trend and cyclical inflation, where trend inflation follows a random walk process, while cyclical inflation follows an AR1 process. Of course, forecasters do not observe the latent variables directly, so instead they receive noisy signals, infer, and update their expectations. Until 2012, they received only one signal, composite signal, about trend plus cyclical inflation. So they do not disentangle which components drive a signal. But since 2012, they started to receive additional signal from the Fed, which is exclusively about trend inflation. And proposition 1 delivers a posterior under smooth diagnostic expectations framework. And here R is the ratio of current period uncertainty relative to the past reference memory. So it measures how precise my current information set is to relative to past memory. And this R affects the conditional mean through tilde theta, which is measuring effective distortion, but also it affects variance, subjective uncertainty. And this proposition 2 is this. So lower R, so higher precision in their information set, leads to less overreaction. And finally, as tilde theta decreases, heterogeneity occurs, inflation expectations become low because less weight is given to idiosyncratic signals that provoke representativeness heuristics and distortion. So to see whether the disagreement across individual forecasts actually decreases after 2012, I measured interquantile range from the SPF data and compared them to simulated interquantile range. In the first scenario, which is counterfactual, individuals keep receiving only one signal even after 2012. And in the second scenario, which is reflecting the reality, individuals start to receive additional signal from the Fed in 2012, denoted by the less solid line. So the two signal models tracks the actual data more closely by capturing the drop from 0.62 to 0.42. And I estimated parameters, but for the sake of time, let me skip the estimation part, and let me go into the New Keynesian general equilibrium setting. So I embed the smooth diagnostic expectations framework into 3 equations New Keynesian model following L'Uriel et al. 2023 paper. And the key modification is in expectations operator. So the standard diagnostic expectations are replaced by smooth diagnostic expectations. And I generated impulse responses function. And on this slide, I'm going to focus on only inflation. And I generated impulse responses in response to 3 types of structural shock: monetary policy shock, cost push shock, and demand shock. And regardless of the type of shock, inflation responses got dampened. And this is due to the additional signal by the Fed. So to summarize, sharing precise numerical targets with the public not only anchors long-term inflation forecasts, but also brings short-term inflation expectations to more rational and less distorted expectations. And furthermore, announcing the inflation target helps stabilizing the response of realized inflation to structural shocks. And that's all I have, and I look forward to your comments and questions.
Thank you. We have time for questions. Gernot?
This is very interesting. Just to understand better, so making again the diagnostic expectation smooth in the new Keynesian model, that gets you closer to rational expectations again, right? And also there was no overreaction. So in the end, I'm left wondering, are we then back to rational expectations? Not quite, I suppose, but in which sense is there still a gap then?
Up to next question.
If I may add, so in your framework, so every shock under your expectation structures has smaller effects on inflation.
Yeah.
So is there a way or a mechanism in your model in which somehow things could actually go the other way around, so that you may have either, given the initial conditions, that inflation may react more, or it's always a property of the model that you're always going to move inflation by less under any shock? Because obviously, one virtue of the model, I mean, relative again to the benchmark, is that when inflation is close to target, that's what you want. But when inflation is away from the target, sometimes you want to move it more. And I don't know whether there's a property of the model that allows you to do that.
Mm-hmm. So let me give an answer to your question first. First of all, yeah, that's a great point, and I honestly haven't thought about the other direction. Yeah, but it's worthwhile thinking about. And I'm sorry, I don't have a answer to your question at this point. And could you elaborate your question again? What was it?
I thought the diagnostic expectations makes people overreact.
Mm-hmm.
Then you make it smoother again. So overreact relative to rational expectations.
Yeah.
Mm-hmm.
And now with the smooth diagnostic expectations, you make it less overreactive, in line with the evidence. So, but that leaves me wondering whether we are now almost back to rational expectations.
So in the smooth diagnostic expectations, more precise information makes agent to form expectations closer to rational expectations. So I'm sorry, I think that I didn't understand your question.
I guess it's more of a comment, and we can always continue later. So our last presentation is by, oh no, sorry, I didn't see you, Guido.
A quick one, just to again understand the model. So when so trend inflation follows around the walk, then the Fed have an explicit numerical target. That means that that is fixed, and the agents know. So there's total uncertainty, I guess, is going to decrease. And why do you need, diagnostic expectation? Even in a standard model, which they have this common filter problem, you will get similar effects, won't you?
I'm sorry, would you just say it again? I'm pretty nervous now, so I can listen to your,
Okay, so why don't we go to Roshni? And
thank you to the organizers for including our paper. So I'm going to be presenting this paper titled House Price Expectations and Inflation Expectations, which is joint work with Vedanta Dhamija at the Bank of England and Ricardo Nunes at University of Surrey. So the standard disclaimers apply. So the motivation for our work comes from understanding new channels of how households form their inflation expectations. And we find a novel channel through house price expectations, and we're looking at the role of salience and salient commodities. But before getting into that, what exactly do we mean by salience? Anything is said to be salient when it attracts the decision maker's attention bottom up, that is automatically and involuntarily. Now, if we apply this definition to the context of household behavior and inflation expectations, there are two obvious candidates that come to mind, which are food prices and fuel prices. It's not very hard to imagine why that would be. People go for shopping, they go to gas stations. Now, these people may not know about what inflation is or what the central bank does, but the changes that they observe across trips gives them a source of information to form a judgment about what inflation is and what it's going to be. So essentially, shopping is a cheap source of information for households. Now, this has received considerable attention in the literature already. Moving one step further, it's the contrasting or the surprising stimulus that catches the attention of individuals, and it affects how they form expectations. So it's been observed that when individuals form their expectations, they rely on their personal experiences. And in those personal experiences, they tend to focus on the larger price changes that they have observed. Now, why this matters is that these items for which they observe larger price changes could carry very low weight in official inflation measurement indicators. But they're paying attention to that. We think one of these larger changes could be house prices. Why house prices are important, we all know that, so I'll skip that in the interest of time. What we do is we first find an accounting benchmark, and in a moment I'll explain why we do that. Then we look at household survey data and see how households, to see the relationship between house price expectations and inflation expectations. And finally, we link this empirical observation to a two-sector NK model. So now, as you all know, CPI accounts for the value of housing services and not the actual house prices. So house price movements enter indirectly through rents, and they're not coming in directly as house prices. So now, if you look at this figure here, the solid blue line is the data for house prices in the US for the last 3 decades. And the dashed lines represent the CPI components relevant to the housing sector. So what we observe is there are large swings in actual house prices, while the CPI components related to housing are fairly stable. So these movements are not, the movements in house prices are not captured in the CPI. But households could be observing these price changes and could be forming their expectations based on that. So what we need is a benchmark which establishes the effect of actual house prices on actual inflation. So we use the data for CPI and CPI housing-related components and see what is the relationship with house price growth. And we find this effect to be very small, which is very close to zero, as one would expect, because house prices are not directly entering the CPI index. So this is what we call as our benchmark coefficient, which is 0.04, very close to zero. So now what are the households doing? We use two sets of survey data, the Fed New York survey and the Michigan survey of consumer expectations. And we look at the relationship between inflation expectations for each individual and house price expectations for each individual. We are controlling for individual demographics, time fixed effects, and region fixed effects. It is also possible that there is some endogeneity here between house price expectations and inflation expectations. So we use an instrument which is the Wharton Residential Land Use Regulatory Index, which measures housing supply elasticity. So we instrument house price expectations through that. So just a brief preview of the results. This is using the New York Fed survey of consumer expectations. So we use different specifications. In the first two columns, we've got the simple OLS results, one for the full sample, one in which we're only looking at respondents at the last period at which they're entering. In the third and fourth column, we are controlling for this possible endogeneity. We use one specification with the Wharton index. We also use another specification where we use lagged expectations as instruments, which has been a common approach in the literature. Across these specifications, we find that our coefficients are significantly larger than what we've observed in our benchmark. So just to summarize the empirical results, our accounting benchmark was very close to zero. But what we find from the survey data is that the coefficient is fairly larger, which ranges in the range of 0.2 to 0.4. We observe the same in the Michigan data also, which suggests that there is overweighting from house price expectations to inflation expectations. So households are paying too much attention to house prices. We also look at some cross-sectional heterogeneity in the data, and we find that individuals with higher numeracy skills or with higher education tend to overweight to a lower extent. So now, to understand the monetary policy implications of this behavior, we look at a two-sector NK model, a simple extension of Galley's one-sector model. This is a stylized model which has two non-durable sectors. Sector O is the overweighted sector, and sector N is the non-overweighted sector. So it's representative of any two sectors, non-durable sectors, where one of them is overweighted. So I've been talking about house prices, but for the moment in this bit, forget housing. This is relevant to any two sectors where one of them is salient to households. So we put this empirical observation that households are focusing disproportionately on one sector. So we define E tilde pi t plus 1 to be the 1 year ahead inflation expectations that are affected by overweighting, where delta denotes the extra weight paid to one of the sectors. So now what this equation here implies is that the distorted expectations, distorted inflation expectations where a household is paying attention to one sector is equivalent to the rational expectations where in the aggregation you're paying delta more weight to the overweighted sector. So if delta was 0, we'd be in a standard a two-sector model. Here we are just saying that delta more weight is paid to this overweighted sector. So I'm not going over the model. But what we find is that this overweighting behavior modifies the IS equation in the model. Here, the real interest rate, now we've got the distorted expectations there, but it doesn't affect the sectoral Phillips curves or the loss function for the central bank. So what essentially this means is there are no additional trade-offs created for the central bank because of this behavior. So what the central bank needs to do is, if it sets the nominal interest rate in line with the expected inflation, it's going to get the same allocations. So to give an example, we looked at the optimal response to a markup shock in the overweighted sector here. So the black solid line is the model that I've just described, where one sector is overweighted, while the red dashed line is the baseline model where there's no overweighting. So now if there's a markup shock coming in sector O, expected inflation increases by much more compared to the baseline model. Now, if the central bank responds more strongly with the nominal interest rate, we're able to achieve the same allocations. Since I'm out of time, just to summarize, we find a novel channel of salience from house price expectations. So this makes a case for the central bank to monitor the housing sector beyond the usual and the very important financial stability concerns. When we also show that movements in expected inflation in any overweighted sector has consequences for optimal monetary policy. So it's important for the central bank to be aware that there are some sectors that households are paying too much attention to so that they're able to gauge the appropriate nominal interest rate response. Thank you.
So we got Anuka and then Seb, and then we'll move over to this side.
Thanks, very interesting. Anuka Ristinimi from ECB. So I'm wondering if it's the households or the central bank who is measuring inflation, because the house prices are clearly an important element of people's consumption basket. When you buy it, it's a huge part of your consumption. So in the survey, first of all, I guess people are asked about the expectations for CPI, not some other inflation measure which properly measures the house prices. But in people's mind, in the end, the house prices are going to be a big determinant. So if instead you had the uncertainty on the central bank side, what would happen in the model if they're targeting the wrong inflation measure?
So I guess sort of relating to earlier discussions about skin in the game, I would be interested to know if there's differences between renters and homeowners in the relationships that you showed.
Matthias Meyer, University of Mannheim. Great talk. The model seems to assign a causal chain from house price expectations to CPI inflation, and I was wondering, I was not so sure whether we can interpret the empirical evidence that way, because even with the IV, differences in housing supply elasticity would also change the propagation of any shock. So they would simultaneously move house prices and CPI inflation. I was wondering about that.
Thank you. Oreste Tristani, ECB. No, I was just wondering, so do I understand correctly that you're using the aggregate price index in the regression, or are these household specific?
Yeah, household specific inflation expectations.
Oh, I see. Okay. Okay, then I have no question.
Just very quick, Guido Ascari, University of Pavia and Dutch Central Bank. One quick question. So in the model, I mean, agents, of course, overweight one of the two inflation, but they get right the inflation rate of the single two goods. Isn't it a bit strange? I mean, they should, understand that, they're getting something wrong, right? Because they get the two inflation rate of the two sectors correct, but then not the aggregate. And you know, these weights are actually you know, easy to check, I mean, to some extent.
Okay. So I'll start with whether the central bank is making an error here or is it the households. So we are not saying that there is an error on the part of the central bank. We are not saying that the CPI measure is wrong, and all we are saying is that households are not able to distinguish between what goes into the CPI and house prices. So see, this is not a comment on the methodology, how CPI is computed, or whether the central bank should focus on a different definition. But it is that households are not able to make that distinction that rents are going in, but house prices are not going in. So that's what we are claiming here. When it comes to renters and homeowners, we've checked that in the data. We find that both homeowners and renters tend to overweight. The extent of overweighting is higher for renters. We don't have questions in the survey to understand the underlying mechanism. So that's why at this point we are doing a randomized control trial to get more understanding of the mechanism behind this behavior. About the causal effect that we are talking about using the instrument, the Wharton index is a supply side measure. The IV works in terms of its relevance and exogeneity because these regulations don't change very often. So they are static because they're based on zoning restrictions and political regulations. So these don't change very often. So all the effect that is going to come to inflation expectations is going to come from the housing side. We also use an interaction with the 30-year mortgage rate to get some time variation and capture the demand side of it. Alternatively, we've looked at fixed effects. We are looking at lagged expectations. So we have a bunch of robustness checks to establish that causality. And I'm hoping the RCT also solidifies that result. And finally, about the two sectors, that's true. What we're seeing is that both the households are able to observe the prices correctly for each sector. The mistake that they're making is when they're aggregating the two. So that's true.
Thank you very much. This concludes our first day. Those who are staying for dinner, don't go anywhere. Just, I think, and will be escorted either to dinner or outside the building. And the conference will resume tomorrow at 9 a.m. Have a good evening.